Dhiren Kumar, CEO at Value Research, with us. Dhiren, morning. While we are joyous about the index hitting 10,800 almost, what is it that you do when it comes to small and mid-cap funds? Because up until 1 month correction was okay when we last spoke, but this is now hitting you hard, the kind of damage that you're seeing on your mid and small cap return portfolios.
No, mid and small cap funds are like this only. And I don't think, one should not lose perspective. Just look at some of the numbers. I would just, put things in perspective in terms of what has happened. Yes, they have fallen, look at small cap funds. They are down 4.5% in last 1 week. They are down nearly 8% over the last 1 month. But not to forget that 2017, they were up 55%. Not only that, if you think in terms of 10-year return from the small caps, they are the best performing fund even if you caught the market high of 2008. The 10-year return from small cap is 16% as compared to the large cap funds which return just about 10%. So catching a market high, holding it for 10 years, seeing the decline that we have seen, the kind of meltdown that you are referring to now, despite that if you earn 16% annualized, generating twice as much return as fixed income, and all your returns were tax free till January 31st, 2018, I think it's a bonanza. Things look far more sharper, far more impressive. Last 5 years, small cap funds are up an annualized 30% despite the declines right now. So small cap funds will be like this only. You will have these big declines in a brief period of time. If you don't have the stomach, don't be in it. But that is why it is not meant for everybody. You remember, all our shows we keep referring to them. Investors chase past performance, and that is why they get attracted to it, and they got attracted to it till January very strongly. But understanding the character of it, they will be like this only. And mutual fund is a great vehicle to invest in small caps as compared to investing in small caps directly. You run the great risk of losing all your money as compared to just, volatility may not be risk, but investing in small caps yourself with less understanding and which is a less researched, less understood component of the market, which is less transparent to you, that could be a great risk, not mutual funds. They will be extremely volatile, and I don't think this is going to change in anytime soon.
That's the nature of the beast. Okay, so you're saying, Dhiren, that don't go by these 1 or 3 month performances. Look at what they've done in the last 5 years, or for that matter even 10 years, irrespective of the market highs, lows, a recession as well coming in. They've in any case made money, and you've been smiling your way happy to the bank. But is it time then, Dhiren, to maybe just try and restrict and narrow down your portfolio holding when it comes to small and mid caps? Do you need to juggle at all? Because if I look at some of the individual schemes like an SBI Magnum mid cap fund, for instance, that's down a good 3.7% in last 1 year. India Value Discovery Small Cap Fund, that's lost about 7.5% this year, at a time when on an average mid and small cap equity fund returns are still in the positive for the year.
Yeah. No, you will have these outliers, but I would still say that, looking at the downside, there were funds in 2008 which were down, not 20%, 30%, 70%, they were down 90%, and they could never make a comeback. So this will also be a testing times for mutual fund managers who were, as the old saying is that, you don't know who is swimming naked till the tide gets over. So as this may not be tide getting over, but yes, some of these situations in the market, the cyclicality of the market or reversion to mean, this will expose some of the fund managers who may not be thoughtful, and or if it turns out to be a permanent impairment of the portfolio value. Be careful, be methodical, but I still feel that small cap funds, mid cap funds are not meant for everybody. In all the programs that I do with you, I keep insisting that people in starting their investment should start with a balanced fund and stop at a multi-cap fund. You get them and you compromise on the return, but that is still worth it, because when you invest in a small cap fund and you see the value going down by 15% in 1 month's time in a not so bad weather, it is quite unnerving. It actually derails you from your whole long-term orientation thinking and being on a methodical plan. So small caps, mid caps may not be for everyone. and somebody who just drifted in small cap funds, accidentally looking at the past performance of recent times, they should think that if they are still, most investors who have been invested, would have invested a year and a half ago, will still be sitting on gains. And if they are getting unnerved, take the money out of it, get into a balanced fund or get into a multi-cap fund, devise a long-term investment plan, because to benefit from the market, you have to remain in the market. A massive blow soon after you invest. So, two things for most investors to do: remain diversified as much as possible, and small cap funds, mid cap funds is not the way to diversify. Be a regular investor. I think, if you stick to some basic tenets, basic principles, you will be okay. If you are chasing recent past performance, you will be disappointed. If you accidentally benefit from just investing in a small cap fund, you are lucky, take your money out, go for your holiday.
That indeed is the case. I have two questions for you. One is on debt funds, given what's happened with rates yesterday. Is it time for investors to look at to parking money in debt funds? I think you answered some of these questions related to bond funds a few weeks back as well, but could you reiterate your opinion?
Yes, fixed income funds should be an essential part of any investor's portfolio. I would say that most investors try and optimize their return or maximize their return on fixed income fund, which may not be worth it. Most investors should just divide that. Is it their long-term money? Maybe stick to a short-term bond fund. Don't try to dabble or maximize your return with a bond fund when you are a fixed income investor. It may not be worthwhile. I have found that most fixed income managers go wrong, and when they go wrong, they don't go wrong hugely. Investors lose 2%, 3%, but investors are completely unprepared for that. Investors in investing in fixed income funds are not ready for taking any intermittent decline. So it is not worthwhile. Be completely risk averse. Don't try to maximize your return. Even if you try to maximize your return, you earn 25 basis points more. And that endeavor or aspiration to earn that 25 basis points more sometimes lands you in a 2% decline in your investment value, which is quite unnerving for a fixed income investor. So look at fixed income funds and ignore these noise, because 25 basis point, maybe it's a huge thing for the money market, for a bank treasury. It means nothing for an individual investor. You should narrow your framework in terms of being in a short-term bond fund, unless you have some 50 crore to invest and 25 basis points will make a difference. For our 10 lakh, 20 lakh, 25 lakh rupees, it is not going to make a difference. Err on the side of caution. Limit your time, limit your framework of operating framework, so to say. Money for few days, few months, few weeks, be in liquid fund. 2-3 years money or trying to derive predictable return, be in a short-term bond fund, no more. Don't try to dabble in the dynamic bond fund. Don't try to optimize it. Let other professional fund investors do it, not individual investors who are looking for safe return with a conservative investment.
But Dhirendra, very quickly, coming back to the equity discussion on mid-cap funds, now 2017 was a great year for mid-cap fund returns, and may have spoiled investors' expectations as well. You're saying that largely there is an element of volatility that one needs to contest with, but even so, between a mid-cap fund, a small-cap fund and a large-cap fund, where would you advise investors kind of allocate their money in the choice of the three, and which are the funds that you would recommend in that category still?
It entirely depends on the experience of investor, because experience of an investor, how long he has been investing in the market through mutual funds or directly, and how he has been able to experience it, that completely alters it. First time investor, they should look, and for their long term money, they should look no further than a hybrid, aggressive hybrid fund, what was erstwhile called balanced fund. 2-3 funds if I have to list, I would say err on the side of caution, go for the balanced advantage fund. The fund manager will have some flexibility too. Investors who have invested for, conservative investor looking for decent return should be investing in multi-cap fund, not large cap fund or mid-cap fund or small cap fund. Investors who are trying to maximize their return, they have a lot of time on their side, they are disciplined, and they have been investing for the last 3-4 years. They have strengthened their stomach to withstand, all the big interim, declines and gains. They should be investing in small caps. They are aggressive investors. They understand what it is, and they will not be upset and disappointed, and they will be disciplined enough to invest through the bad times. In fact, maximizing return from your small caps and mid caps, the secret is choose a good fund, invest through the bad times. It'll and have the patience of 5 years. If in fact, when investors started investing in those micro cap fund and the small cap fund, they were looking at the return of investing in the worst of times, and when these funds actually went up, all your worst of times investments, they just multiplied dramatically. So investing through worst of times, the discipline that is the secret of generating that return. Choose from our standard recommendations. Those funds actually the three criteria which I look at, that what has been the worst downside, and eliminate funds on that, because Indian funds, when they get into the bad weather, or Indian markets in general, they fall so sharply. It's very unnerving. So somebody who has in his portfolio devised a mechanism of falling little less. And two things which one should which is entirely in the hands of investors, is that never invest lump sum, and always invest through the worst of times, because these are two situations. The moment you see that your money is going up, something in January we had investors who were just wanting to know the best fund so that they can catch the missed bus. They will be greatly disappointed. Never invest lump sum. And when you see the worst of weather in the market, that is the time when people actually stop their SIP, and they start cursing the equity investment and the small cap fund. If you can do these three things, and for all this you need the long term orientation, for which you need you should be investing the money which you are unlikely to need for next 5 years. If these variables are in place, you'll be okay. Otherwise, keep away from the small caps and the mid caps. Most investors can generate decent return without having them.
It's always the old principle of buying fear and selling into greed that would make money. But Dhiren, always great to gather some perspective from you, and I guess the answer is out there. Don't redeem your SIPs in small and mid cap funds. Perhaps right now is the time to systematically, albeit, but if you can really take that churn and the volatility that small and mid cap funds bring about with them, right now is your time. But